Today, we're opening up a very specialized, and I have to say, pretty aggressive analysis report. It's focused entirely on one company, ONDS Holdings. Ticker is ONDS.
That's right.
And our mission here is to basically pull apart this analysis and figure out what core arguments are driving this huge wave of bullish sentiment around the stock.
Exactly. And if you've been watching ONDS, you know the price action recently has been, well, explosive. This analysis we're digging into is essentially a blueprint for let's say, a high-risk, high-reward idea.
Right.
It's mixing technical chart reading with some very specific business drivers. And the big question they're trying to answer is, after this massive surge, is this just the beginning of a sustained run up to a $15 valuation?
A $15 target is, that's incredibly ambitious, especially when you look at the volatility in this sector. So just to be clear, we're not here to say if that's right or wrong.
No, not at all.
We're here to understand the evidence, both the technical and the fundamental, that this report is using to even make that forecast. It's a report that's very heavy on conviction and, let's say, light on caution.
Yeah, that's a good way to put it. It's very forward-looking. They're not really interested in what happened last year. They're trying to identify momentum now and map a path forward.
Okay, let's unpack this.
Let's do it.
So let's start right where the market did, with the raw price movement. The analysis report makes a huge deal about the closing action for the year. They don't just say it was strong, they call it an explosion.
They do. It wasn't just a slow climb. It was a sudden, surge of buying.
So what are the numbers?
The stock put up a massive 8.57% gain in a single trading session. But, while that percentage is impressive on its own, the real story, according to the analysts, was a psychological barrier that it tested.
The $10 level.
The $10 level, exactly. In trading, these big round numbers like 10 or 100, they act like magnets for resistance and support. Breaking through is a big deal.
And if you can punch through a number like that, it just changes the whole narrative for the stock, right? The report seems to spend a lot of time on the intraday action.
It does, because that shows the quality of the buying, not just the end of day result. It wasn't just a strong close. The momentum was there from the very beginning of the day.
So it gapped up.
Precisely. They highlight that the stock gapped up, opening at $9.28. That's already way above the previous day's close of $8.99.
And a gap up like that is a powerful signal. It means buyers were lining up before the bell even rang.
It shows real conviction. And that initial energy just carried it right through the morning. The high for the day hit $10.53.
So it did it. It broke $10 intraday.
And that's the key technical achievement this whole first part of the report hangs its hat on. Breaking the $10 ceiling, even for a moment, is critical. It proves to the market that it's possible.
But it didn't close above 10, did it?
No, and the analysis points out there was some predictable afternoon profit taking. You see an 8% gain, you lock it in, but the stock held its ground and closed really strong at $9.76.
So even after people took profits, it stayed right there on the doorstep of $10. It held the high ground, so to speak.
What's fascinating here is the report interprets this as proof that the buyers are, and this is their word, hungry.
Hungry.
Yeah, displaying high conviction. The analysis suggests this isn't just, random retail excitement. They believe it's confirmation of larger, maybe institutional interest, setting a new floor for the stock.
Okay, so that makes the technical case. Strong move, broke a key barrier, held the gains. But a breakout like that, well, it only matters if there's fuel underneath it, right?
Absolutely.
Here's where it gets really interesting. Let's look at the underlying reasons the analysis report claims this isn't just a meme stock pump, but a fundamental repricing.
You hit the nail on the head. A technical breakout needs a story. And this report makes a very aggressive case that this is a fundamental repricing. The core of that thesis is just a jaw-dropping growth rate.
The number they cite it's huge. Revenue growth of 582% year over year.
582%.
That kind of figure, if it's real and it's sustainable, it just instantly changes any valuation model you could build. The report says this is all coming from the rapid scaling of their autonomous drone tech.
Now, when you see a number like 582%, the first question you, as an investor, have to ask is this coming from a really low starting point? Is it just going from 1 million to 7 million?
It's a lot easier than going from 1 billion to 7 billion.
Exactly. The report doesn't get into the baseline specifics, but the authors use this number to argue that the company's moving from like a proof of concept stage into a massive scaling phase. And that is exactly what growth investors are hunting for.
Okay, so that suggests market traction. But growth like that costs a ton of money. It requires capital and lots of it. So that brings us to their cash position. They recently raised money, right?
They did, and it gave them a huge cash position. The report describes it as over $400 million.
Over $400 million.
Correct. And normally, when a company raises money by issuing new shares, investors get worried about dilution. Dilution is kind of a dirty word because it means your slice of the pie just got smaller.
Wait a second, though. I mean, $400 million is great, but that capital raise did cause dilution. This analysis is super bullish, but aren't they just asking shareholders to take on all this risk based on a promise of 582% growth? How do they just brush past the dilution?
That is the critical point, and the report tackles it head on. It frames the dilution not as a negative, but as a strategic necessity, a means to an end. They argue this massive cash reserve is a weapon. It lets the company scale aggressively and, their words, dominate the autonomous drone and defense market. So in their view, the potential for market domination completely outweighs the short-term cost of dilution. That $400 million is the rocket fuel.
So their argument is that speed and market share in this emerging sector are more important than the current share structure. They're betting on the future growth, not the present-day ownership percentage.
And that leads directly into the third big fundamental point, the sector hotspot argument. The report is very explicit about linking the stock's positioning to rising global tensions. This isn't just a commercial drone company anymore.
No, it's a defense and security play.
This is where the macro picture really kicks in. The report argues the demand for what ONDS makes isn't tied to the economy. It's driven by geopolitical necessity. They're very clear on this. Global tensions have created an all-time high demand for counter-drone tech and autonomous security. And they're basically saying ONDS is perfectly positioned to scoop up government and defense contracts in this environment. It completely reframes the company.
If we connect this to the bigger picture, the core argument of the report is that ONDS is in a perfect storm. You have insane internal growth, that 582% number.
You have the capital to pour on the fire, the $400 million.
And you have these huge geopolitical tailwinds pushing demand higher than ever. And that combination, according to this analysis, is what justifies tearing up the old valuation and setting the stage for $15.
It's a very neat, very aggressive thesis. Now we just have to see how they actually map it out on the charts.
Let's do that. Let's transition to the price targets and the technical roadmap. We know the destination is supposedly $15, but what is the reported path to 15?
So the analysis starts with external validation. It notes that the broader Wall Street sentiment is already shifting in their direction. They cite that other analysts are apparently issuing strong buy ratings.
And the price targets.
Those consensus price targets are moving up. The report says they're in the 12 to 1350 range now.
Okay, a consensus moving toward 1350 is a big deal. It suggests that, the big institutions are getting comfortable with a much higher valuation, but $15 is still an overshoot. What has to happen technically for that target to be in play?
The report lays out a very clear two-step roadmap. Step one is just solidifying the recent breakout. The stock has to hold the 950 to 970 level as new support.
Like a new floor.
Exactly, like a new floor. If it falls below that, the breakout is a failure and all that momentum is gone. And since it closed at 976, they're saying it's, balancing right on that critical floor right now.
Okay, so step one is hold the floor at 950. What's the next hurdle to get to 15?
The next major leg up means testing the 52-week high. The report identifies that as $11.70. That level is a magnet for attention. Breaking a 52-week high is a huge technical signal. It brings in a whole new wave of momentum buyers.
People who want to jump on a stock that's entering blue sky territory for the year.
Right, so the process is simple. Hold the new floor, then break the old ceiling. It's a very clean technical setup.
And that leads to the most bullish part of the forecast, I'm guessing?
It does. The report summarizes that once ONDS clears that 1170 level, there is, quote, very little resistance stopping a run to $15.
That phrase, very little resistance, it can sound like just marketing hype, but in technical analysis, it has a specific meaning, doesn't it?
It does. It's chart speak. It means that between $11.70 and $15, there hasn't been a lot of historical trading. So there are fewer old investors sitting there just waiting to sell their shares at their break-even point.
Fewer sellers means the buyers can push the price up much faster.
That's the core technical argument. That's why they expect a rapid acceleration above 1170. And it's also why the report suggests any dip, as long as it holds that 950 support, could be a golden opportunity to get in before that next leg up.
It's a real confidence play in their technical roadmap.
This raises an important question, about the weight this specific report gives to technicals versus fundamentals. The technicals give you the timing, the entry points. But it's the sheer force of the fundamental growth, that 582% revenue, the war chest, that provides the conviction to even aim for $15 in the first place.
So the technical setup is the countdown timer, but the 582% growth is the rocket fuel. That's the synthesis they're trying to sell.
And it's that combination of explosive growth and a clear chart path that's driving this incredibly bullish conversation.
So what does this all mean? Let's wrap this up. We've covered this entire very aggressive analysis. We started with the sharp price action, that 8.57% explosion that broke the $10 ceiling.
Suggesting hungry institutional buyers.
Then we moved to the fundamental fuel, the astonishing 582% revenue growth, and that strategic $400 million war chest.
All positioned to take advantage of this rising demand for defense tech, driven by global tensions.
And finally, we looked at the path of $15, the consensus targets moving up towards $13.50, and that technical roadmap that needs to hold $9.50 as a floor and break $11.70 as the ceiling.
Right, where the report claims there's very little resistance on the way to 15.
The bottom line is, you now have a complete picture of the specific arguments driving this whole conversation around ONDS. The report is basically betting that 2026 is the year of defense tech, with this company leading the charge. This gives you the context to evaluate all these claims for yourself.
Exactly. Understanding these drivers lets you critically think about whether this roadmap is sound. You know the story behind the momentum, and you know the exact price levels. That $9.50 support and $11.70 resistance that will either prove or disprove the report's short-term thesis.
And as a final provocative thought, the analysis sets $15 as the target, but they also float the idea of holding for a more speculative $20 target. So, based on these claims of 582% growth and this prime market positioning, how much weight should you really place on that kind of growth when evaluating targets that go way beyond what even bullish analysts are saying? And when a report says very little resistance, what does that truly mean in a sector this volatile, where one lost contract could create massive unexpected resistance overnight? That's something for you to mull over.